All right, hello and welcome everybody. Happy New Year, and welcome to Trading Coaches Playbook. Let me go ahead and I didn't share my desktop. Sorry, let me go ahead and do that. Just realized, and there we go. So now we're official. So again, welcome back to first session of Trading Coaches Playbook for 2025. Welcome, Brenda. Happy New Year to you too, and everyone here. My name is Brandon Wendell, and I'll be your host for next hour, I guess, or thereabouts. Um, Before we get started, just need a quick reminder that we are not broker dealers or investment advisors. So we're going to look at the charts. Sorry, grabbing something here. We'll look at charts and markets, but we're doing it from an educational standpoint. I'm not telling you to buy, sell, or hold anything in particular. Giving any personalized recommendations about the markets. All markets do involve the risk of loss. That's always a situation. No matter what we do, we can't eliminate the risk. We just try to minimize and manage it. And we are not subject to trading restrictions, so we can have positions in a security or initiate one at a time. And actually, I forgot to open up a few things here, so I'll do that real quick. If you want to stay in touch with us, we have a lot going on. We got a lot of workshops happening here. It looks like had a recent Fibonacci mastery one going on. It'd be repeated on the 10th. We got Inner Circle going on. I'm involved in what's called the E-mini think tank. It keeps me pretty busy. Basically, we meet up 3 days a week. There's a lot of online education as well, on demand. I'm actually going to be reproducing, or have reproduced, I should say, a lot of the educational material. So it's going to be all brand new coming up in just a couple weeks. As I log in here real quick. And let me see. Go out here to, apologize, I should have logged in all this stuff earlier, I suppose. But there we are. Anyway, if I go into the E-mini think tank, basically it's a multi-level program where you have the educational resources available to you 24/7. It's basically on-demand education. And what happens with that is you can absorb it however you want, as much as you need. And then we meet 3 times a week in the live markets to analyze and put to use what we learned. And basically, kind of goes off of what I learned in my background in trading. And again, if I go into E-mini Think Tank, you'll see some of the info there. And I'm bringing this up for a purpose, a reason, obviously. But yeah, the E-mini Think Tank, again, we're kind of redoing all these bonus videos. There's tons of them with different education. It's going to be all broken down as special subjects. There's even a video that's going to be there on what is here. If you go into the documents, there is already what is here. It gives you kind of an idea of where to start and what to read, when. Basically, there's documents that support all the educational material. So for instance, we're going to be talking a little bit about some of the choosing the right targets. We're going to be talking today a bit about trend reversals, picking tops and bottoms, and actually covering, I think it's under my core strategy, trading routine and finding zones. So my subject for today is basically order flow and reading the charts a little bit better and understanding price action on those charts. So like I said, if you want to get more information on that, the link's there. You can join us at the E-mini Think Tank and try it out. Cool thing is, if you try it quarterly subscription, you get a 2-week free trial, and we don't charge your card until after the 2 weeks. So you basically get to kick the tires and try everything out for free without any risk whatsoever if you do the quarterly subscription. So I think that's kind of cool. So anyway, we'll jump into this. And again, I run a few different programs, but I'm going to kind of focus on the E-mini Think Tank for the most part today, although I do use the same tactics and techniques in all of these programs that I run. If you're brand new to futures, never traded before, I do have a futures boot camp, which kind of introduces you to the futures markets and how to trade those. The Wealth with Spreads is a little more advanced types of futures trading. And then the SPX Cash Flow Secrets, it's actually an options program that I run that shows you opportunities to, some opportunities to create income on a daily basis. But basically, I'll talk a little bit about my background. I started off in the industry as a retail broker, and I worked with customers. Obviously, I would talk to them and ask them to buy a security or figure out, what their needs were and try to recommend certain securities they can invest in. And I didn't really care for it. I ended up I had a bad experience, let's put it that way. The brokerage was kind of like those penny pushers back then. And if you ever seen the movie Boiler Room or Wolf of Wall Street, that was my experience. So I decided to go and move into a different brokerage where a little bit more scruples were in place. And, my ethics prevented me from recommending people into things I didn't think that they should need or want, or should be in risk wise. So anyway, I moved into a back office operation where I was working as a trader for the brokerage. So I got to see what's called order flow. And it was a completely different view of the markets. And it's actually what drives the markets even today. Nowadays, we don't have a lot of uh, we don't have physical paper pushing around for orders. It's all electronic, and we don't have physical people necessarily pushing. We have still have brokers, but for the most part, a lot of people are self-directed when it comes to their brokerage accounts, especially here in the trading realm. So back in the day when I was working for the brokerage, basically an order would come in. Either the broker would talk to the customer, or the customer would call in, or whatever it may be. And we had these chits. Basically, they would write up a blue order for a buy and a pink order for a sell. Those aren't the actual ones that I was using, but they're very similar. And what would happen is the chits would be giving to me at the trading desk, and I would be tasked with executing the order, getting the order filled for the customer, but also at the benefit of the brokerage. And if you're not familiar, we have what is called the spread, where basically, if you look at any security, for instance, I'll go out to the NASDAQ right here, and I'll enlarge this one. And if I bring in active trader, you'll see that there is, let me enlarge this. But here's the pricing for the NASDAQ right now. You got people who are bidding or wanting to buy, and you have people who are willing to sell over here on the ask or asking. And you notice the buy price and sell price are not the same, right? So the inside bid and inside ask are different. And basically, as a broker, my job was to get a good fill for the customer, but a little bit better for the brokerage. So if I could buy it at a slightly lower price, turn it over to the customer at the higher price, that's perfectly legal, and we got to keep the difference for the brokerage. Plus, we charge a commission to the customer for the right of ripping them off. I mean, again, it's just the way the industry works. So that's why a lot of people do direct access trading, which is what I'm doing here with this. This is the Thinkorswim, which is now Charles Schwab. You got TradeStation. You got a lot of different brokerages out there that offer direct access trading, where you're kind of skipping the middleman, but there's still market makers and order desks that you're dealing with. Yeah, this would be the same as the Dome or the Matrix, whatever you want to call it, different platforms, different tools they use. But yeah, they're all the same. Um, I actually have TradeStation here too. I just didn't open it right now. But yeah, so I would basically be tasked with getting those orders filled. And back in the day, we actually had CRT monitors. If you remember those, they were monochrome. I actually have a picture here, cartoon of one. That's kind of what my computer looked like. It was those big monitors that only had green with the monochrome. And I basically would get those orders filled. And it was interesting because, yeah, at the time, because we had those papers, the chits, you could literally see stacks of orders. And I've had friends who worked on the floors of different exchanges, and I've talked with them, and it's a very similar experience where the clerks of the exchange would actually stack up orders based on price. And you would see the buy order stacking up, the sell order stacking up based on the price action and based on price, where those orders were supposed to get filled. So that was my job. I basically route the orders through regional market makers and to the exchange. Well, technically not the exchange. I had to go through market makers because they had the relationship with the exchange. So that's the same thing that happens nowadays. We don't directly communicate with exchanges. We communicate with ECNs, or electronic communication networks, that route our orders either to other traders on that same level, or that send your order to the exchange to get filled either by market maker specialists or other ECNs. So there's still this electronic back office that's going on. It's just not physical like we used to have our offices, and we used to go in and do these trades, but it's still all done. It's just done much, much faster. And that's probably a good thing. But there's still a lot of the same manipulation, a lot of same stuff going on, which is pretty advantageous for people who know how to identify order flow. That's really what it comes down to. If you can identify order flow, you can predict where prices are likely to be moving. And when it comes to price, again, I'm going to be talking a little bit about this order flow, but I'm also going to be talking about 4 key things I'll bring it up here. Actually, no, I'll do it here. Go to one of my charts here and minimize that for now. Let's see, what was my alert? It's nothing for now. This is my chart I use for the SPX later right here. I'll refer to that in just a bit. I'll show you what it's all about. But again, since I was talking about the NASDAQ, I'll go there, NQH 2025. There we are. And I'll clear this chart up for now. Basically, when it comes to reading price, I mean, price is everything. It tells you what is likely to happen, what has happened. And we actually infer what is going to likely happen based on what has already happened. And that's what we're seeing on the chart. The chart is representative of buyers and sellers that have come together, agreed at a certain price to make a transaction. It's a literal record of past transactions. But we can, knowing what the markets, how they work and what they do, we can infer some things from this information. And really, when it comes to reading price, oops, didn't do that. There we go. And I'm going to enlarge that so I can see it better. There we go. And when it comes to reading price, really, there are four key things. Actually, I'm going to do another one here underneath. So number one, nope, that's not what I wanted to do. Okay. Color, shape, size, and location. Okay. So if you can master these four things, you're going to be way ahead of most people when it comes to trading in the markets and understanding what price is likely to do in the future, short term or long term, doesn't matter. That's the cool thing about price action and charts as a whole. They are fractal, and fractal means that the pieces are the same shape as the whole. They all work the same way. So whatever techniques I want to apply to this daily chart will also work if I switch all the way down to, say, a 5-minute chart. Just got to look at the right perspective. But candles are candles. If you take away the price and the time, it doesn't matter what you're looking at here. I mean, it could be a 60-minute time frame, or once again, daily or weekly even. So, but the key thing is understanding price action. These four things can really assist you in making better predictions about the future. And that's all we're doing. We're trying to make educated guesses about what price might do in the future. That's all. So when it comes to color, and some of you may be colorblind, that's fine. You can change the colors of your charts to whatever you like, but traditionally green is bullish or upward price movement, and red is bearish or downward. All right. So we see a green candle. We know that based on the body of that candle, we ended up, so move that out of the way. We ended up opening at the bottom of the body, closed at the top of the body. So when it comes to the color, one of the key things to look at, and I should actually take a step back here before I dive into this a little bit more. When I'm looking at certain things, I use different time frames. Whenever I'm trading, I always use a minimum of 3 time frames. Okay. And the reason why I use 3 time frames is it gives me proper perspective and an idea of what price is doing. So my lowest time frame, I call it my zone time frame. And actually, I'll do this, say lowest is my zone time frame. And that's where I'm finding my entries and targets. Exits could be stops or targets. So that's my lowest time frame. Then I have my intermediate time frame, and that is for the trend. That's the best trading direction. I want to trade in the dominant trend's direction. And then number three is perspective time frame. That's the highest. And you can go higher or lower from there too, but my highest time frame is perspective. And actually, I want to call this the trend time frame. And for perspective, it gives me signals where trends pause or end. So it gives me an idea of where prices are likely to stop in the trend and where they're likely to reverse. We want to be able to join the trend as early as possible. And that perspective time frame tells us where that's likely to be. Or we want to get out as late as possible to maximize our profits. So basically, that's what the perspective time frame can give me. Now, when I'm reading price color, I'm typically going to be focusing on the intermediate time frame because on that intermediate time frame, I am looking for the trend. So let's see here. Focusing there on that intermediate time frame. And there's a relationship between the time frames. I don't just randomly pick certain time frames. I need to make sure they're related to each other. So again, if you go to the E-mini think tank in trading routine and finding zones, and also in the new videos, again, I'm re-releasing things, but right here in trends, I describe exactly what time frames and the relationship that between them should be. Because you don't want to go from an intraday 5-minute chart and then to a daily chart to get your trend, because you're going to be missing out on intraday trends that are going to be affecting your trading. So we need to look at what is actually going to be affecting us and ignore some of the noise that won't bother us. So when it comes to the color, basically, it's actually pretty simple. Like I said before, green is bullish, red is bearish. What we're looking for is if there's a dominance, that's a strong trend. And that trend is typically going to maintain itself and continue to be strong until you start to see the mixed colors coming in. It starts looking like Christmas, red and green, right? So if you have mixed colors, now this is not perfect, okay? Not everything works exactly every single time. Again, when it comes to trading, all we're trying to do is put the odds in our favor, look for the highest probable direction or probability for price. So, again, if I go, let's go to a different chart here. Let's see, what do I have? Bitcoin, why not? Bitcoin futures I was looking at here on a 4-hour time frame. So basically, again, it doesn't matter the time frame or the chart. I go to a certain area, let's fix that, and just look. If I'm seeing mostly green and large green candles, and we have a very strong trend. Well, we had a bit of a domination through here, but it's not very strong because we got mixed red and green. Now we got 5 red together, so obviously the trend is getting a little bit bearish, but it's not just solid one color or the other. So this is a weak trend. Notice here, the trend picked up a bit more. Ignore the blue, actually. Let me go ahead and edit studies and turn that off for now. There we go. So you can see that, there's a domination right now. 6-2 in the last 8 candles are green. The green candles are much larger than the red. So obviously it's a bullish trend. Yeah, ornaments on the tree, right? The red and green. So even here, continued on with mostly green. So we have, and you can kind of see it when you look at price itself. Right through here, kind of weak. Here, domination of green until those red pops in. Notice how we're at a steeper angle of attack. We have a stronger trend, period. Even if I go back a little bit, here there was a bit more green. Not by much, but the greens were much larger. But through here, it's kind of mixed. So this is, again, on your trend or intermediate time frame, the color domination can help you identify whether the trend is strong. And if you're trading in the trend, it may keep you in the trade a little bit longer with the confidence that, hey, this is working out. I'm going to continue making profits here. Once I start seeing that mixed color coming in, then I know that the trend may be closer to an end and I might have to tighten my stop or look to book profits. That's all. Here we see the red starting to creep in. We've lost our domination. If you take a look at the overall price action, you can even see the angle of attack has gone shallow. And what happened? Well, prices started to get strong to the downside, didn't they? Domination of red right now. Let's see how long that trend continues. Not too long, but it was a bit of a move. Right here you can see domination of red for the first time for a while. Large red candles continuing down. Now we start getting green, red, green, green, green. As soon as we start getting multiple greens together, that trend might be ending or reversing. Now we've got a strong uptrend. How do we know when that's going to end? Same thing. When you start seeing the red candles coming in. Oh, there's one, there's another, and another. And what's happening with that trend? It's dying off. Now, we don't live in a vacuum. I also don't want to focus on just one thing. It's color and or shape and or size and or location. So I take into account all of these four things to identify what's going on with price. And you'll see what I mean in a little bit. So with color, again, the domination of one color or the other can give you an idea of how strong the trend is or when the trend is getting weak and you might need to look for exits or booking profits. Or maybe you're looking to time the reversal of the trend to go in the trade in the other direction. Now with shape is basically, we have four prices on every candle. You have the open, high, low, and close. Out of those four prices, the closing price is the most important. And the reason why is every period of time or whatever it is you set your chart for, okay, that chart interval or period or whatever you want to call it, could be a 5-minute period, it could be a 1-hour period, it could be daily, it could be share-based or tick-based, meaning the number of trades going through creates the size of the candle, or the number of contracts or shares being traded, whatever it may be. Okay, so out of that period, there's a battle between buyers and sellers. And, if there's a lot of aggressive buyers, they may be pushing prices upwards because there's no sellers there. If they're aggressive, the buyers really want to get in. The sellers take a step back and say, well, listen, if you really want in, you'll pay this higher price. So we'll see how that works in just a little bit. The most important is the close right there. I put it in the text as well. So the close is the most important. And basically what I'm looking for the shape is the closing price versus the high and the low. I want to see where are we closing in relationship to those two things. Are we closing near the high? Are we closing near the low? That gives us, again, an idea of dominance of the buyers or the sellers. So basically, I'm looking at the wicks or tails. Okay, that's no problem. You can ask questions if you miss something. So, for instance, if we have a green candles are normally associated as bullish, but we've got a green candle right here. And you can see that close is pretty far away from the high, and it's actually closer to the low. Even though that's a green candle, that means there was bearish pressure that caused us to fall away from the high and close much lower. That's a bearish candle, period. And the same thing could happen with a red candle if there's a big bottom tail. So let's go back here. And again, I'm using my Bitcoin example. Doesn't really matter. I'll go ahead and clear the chart again. Probably should use a different time frame. Oops, got to change this on the chart this way. And maybe not. Just need to be in an active period. But again, what I'm looking at is the shapes of the candles. For instance, here we have a nice domination of green. bullish trend. And it actually happened twice. Whoop, there we go. Here's one. And notice at the end of that trend, where things start to turn, we were warned by price. Basically, what happened is that, yes, we had a green candle, but we closed well away from the highs. This one closed very close to the low. That means that there was very little bit of buying pressure there, and we were dominated by sellers. And same thing here. You can see we've got a lot of buying pressure, and that topping tail is pushing us back down. We couldn't close anywhere near that high, so the sellers dominated during that period. That selling pressure is equal to the height of the high to the close. The buying pressure is from the low to the close, and we have slightly more selling pressure than we have buying pressure. Not to mention the tail grew compared to the previous candles. Even here, we had good buying pressure. We had a bit of selling pressure, less selling pressure. Selling pressure picked up very little, but couldn't make a new high. And when we tried to make a new high, we had too much selling pressure and we died off in trend. So this will not always happen, but it happens often enough. Right here, we've got red candle with bottom tail, green candle with bottom tail. What is that telling us? Well, that is telling us that we could not close at the lows. There's a lot of buying pressure, and the sellers are very, very weak right there. So we're more likely to push to the upside rather than down. And that's what we did. We started going back up again. But once again, little subtle things like this can really mean a lot. Topping tails on these candles grew, and we started falling back down, at least temporarily. Now, it won't always be that clear, and it's much easier looking back than it is in real time, obviously. But when you look at some of this stuff, let's say, okay, right now we're in a downward trend. We've got a dominance of red, so we know there's lots of selling pressure. We're very strong downtrend. And it looks like the selling pressure is getting a little weaker as we get these bottom tails coming in. So we might be getting closer to a bottom, not there yet. Now we've got lots of buying pressure here, a lot less selling pressure. So if we're going to turn, this is a warning sign that prices are either done moving down and are pausing, or are done moving down and looking to rally soon. And then we started pushing back up. Look at that. Once again, indecision. Now we have selling pressure and buying pressure almost equal because we're closing near the middle of that candle. And that's kind of like when you lose momentum. Say, for instance, I got my notepad, you toss in the air. At some point, the inertia and gravity are equal. This stops in the air, and then gravity takes over and takes us back down. Same thing can be said about price. Buyers were pushing us up, but then they were met with equal selling pressure. And if the buyers give up, we go down. As a matter of fact, the very next candle warned us of going down, didn't it? We were moving up, indecision, so buying and selling pressure are equal. Lots of selling pressure, very little bit of buying, and we pull back down. Well, we might be done moving down. We got our buying pressure back again. And look at that. Even though those are red candles, that's buying pressure. We have the bottom tails there. Oops, surprise. Like I said, it doesn't always work. That would have suggested we might be getting ready to go back up. We don't have a strong trend, though. Remember, red and green mixed. And that was just kind of out of the blue. And that happens. But at least we can get some sort of clues. And the shape with the close versus the highs and lows, that's something I look at on both the lowest zone time frame and the intermediate trend time frame. So here, oops, that's not what I want to do. There we go. Let's see, pressure. There we go. And also shape. strength or weakness. I can spell today. There we go. All right. So that's a little bit on color and shape. Size is the size of the candle. And we have really overall three different types of candles. You have normal range candles, which means it kind of fits in the same range, the same size as the other candles around it. Range, by the way, refers to the absolute highs and lows, not just the body of the candle. Okay. But then we also have what are called narrow range candles. And those are obviously small candles between the high and the low. They have a very small range. We didn't see a lot of price movement in either direction. So those narrow range candles, they can indicate indecision and weakness in the trend. Now that could be a pause or it could be a reversal. It's going to depend. Out of these four, color, shape, size, and location, really location's the most important. It's kind of like real estate, right? What's the most important thing in real estate? Location, location, location. Oh, on the candle previously, yeah, there was an evening star that could have been bearish, even though it was a bullish type of candle. Right. So anyway, with size, narrow range candles, again, we take a look at a chart, and you're right, that kind of gapped up before it dropped off. That could have been seen as a bit of a bearish signal right here on its own. But basically, when you see narrow ranges, expect possible change. Not really seeing any great examples right in here. Let's zoom out a little more. Maybe. Well, again, nothing like really standing out. Often the narrow range candles will be in a group. And for instance, right here, you can see we've got 1, 2, 3, 4, 5 candles right here that are pretty small compared to the candles around them. And it was just a pause. Like I said, it could be a pause or reversals. Okay. Or right here, we're rallying up smaller range candles, 1, 2, 3, 4, and the change in trend. So those are narrow range candles, something to keep an eye out for, which can give you, again, if you're in a profit and you see those, the location is going to be most important, but it could tell you, hey, we're pausing right now. Be braced. We could get a reversal or we could get a continuation. It's really going to come down to the location of where price is. Okay. And I'll talk a little bit more about that. It's the institution stuff, Karen. I'll answer your question in a moment. It's a great question. The question was, don't the institutional buyers buy in small amounts up or down or kind of melt up or melt down to counter that? And I'll explain that in a little bit. That's what I'm going to get into too. So let's see. We have the narrow range candles. We also have expanded range candles. And those are obviously large candles or large range. Just compared to the ones around it. Now, a key thing with those large range candles is going to be location. Okay, because what happens is if that is kicking off the start of a move, it's usually professionals. And Karen was mentioning, don't the institutional buyers buy in small amounts? Well, yeah, actually, they do quite often. So going back to my slides right here, I was getting into that. When it comes to order flow, basically what'll happen is, say for instance, you want to buy. Did I do this right? No. I lost my animations on this one, didn't I? I forgot to copy those over. Doesn't matter. Actually, a better way to show this is coming up here. Right here, working the order. So for instance, if an institution wants to buy something, they typically want to buy a large sum. They're not buying just a couple shares or a couple hundred shares. They're buying millions of shares at times, or even, tens of thousands of shares. A block order is considered to be 10,000 shares or 10,000 contracts or more, depending on what it is you're trading. But on the equity market side, with the NYSE and NASDAQ, typically block orders are 10,000 or more. those are kind of flagged as institutional orders because, as individuals, we're not buying that much typically unless we're buying penny stocks. I could be wrong. I mean, maybe you got some good inheritance. I don't know. But what happens with those institutions is they don't want to stand out. If you look at the market when it comes to stocks, I don't know. I don't think I have level 2 enabled on mine, but you mentioned NVIDIA. Oops, go there. And let's see, active trader, level 2. That's what I was looking for right there. Not active trader. That's level 2 right there. And it's not really followed as much as it used to be. When I first started trading, I was a scalper, and we basically didn't even trade off charts. I simply looked at level 2 trading and traded off this. But what you're seeing, and yeah, I don't have all the information. I have a bit. You can see companies like JP Morgan Stanley, Goldman Sachs, American Express, and some of the exchanges, even BATS, Edge, NASDAQ. What else we got here? Cantor Fitzgerald, Morgan Stanley, a couple other names I recognize from time to time. Cowen. Anyway, those are market makers. Lehman Brothers. I don't know who's taking over there. Somebody's taking over their symbol. I don't know who it is now, but anyway, UBS Securities. But those market makers, with what used to happen would be they would use their actual ID. Notice where UBS is right now on the bid side here, way down. Current bid is 143.92. Where are they sitting? 131. Why are they nowhere near the market? They're required to be there on both sides. So they're right here, willing to buy at $131.34. They're also on the sell side right here at 154.65. They're only showing 100 contract or 100 shares that they're willing to buy or sell. Okay, this is the ask size times 100. So UBS is saying they're willing to sell 100 shares at 154.65. They're willing to buy 100 shares at 131.34. The market's nowhere near that right now. The sell price is 144 basically. 143.99 by 98, 99, something like that. So what happens is these guys used to use the real IDs to buy and sell, but everybody would start watching them and try to piggyback off them. I mean, when I first started trading, I sound old now. Back in my day, we used to trade in teenies. It was a 16th of a dollar. So we were trading with fractions, not even in decimals. And the smallest fraction was basically a teeny or 16th of a dollar, which is 6 cents. And what would happen is the electronic traders like ourselves, we could go as small as 256th. So if Morgan Stanley, or in this case, UBS, put in a bid to buy, and they were going to buy a large amount of shares, I know that's a huge amount of demand and could push prices higher. So I could step in front of them just 256 higher and actually front run them and get filled before they do. Well, they don't want that because if everybody keeps doing that, it pushes prices away from where they want to buy. So they started using these other IDs like ARCA, Edge, and these other, what they call ECNs. I mentioned them earlier, electronic communication networks, to be anonymous and buy. But even there, 1,200, 3,700, well, 10,300. That's a lot of people trying to buy all at once. That's not one person. Nobody wants to jump in with a large number of shares because it'll scare the market one direction or the other. If somebody jumped in with 100,000 shares to sell, people start panicking if they see that, and they'll start selling off, and you would never get to sell everything you wanted to sell. So instead, you do what's called working the order. And I didn't mention this, but when I left the brokerage, I actually went to a private hedge fund, and I became a trader for a private hedge fund. Well, we had lots of money to spend, and we were buying large amounts of shares. So I actually had to do this in order to get my orders filled. I had to work the orders like these big institutions do. You break up your orders into small pieces and try to blend in and buy when you can within a certain range. If prices leave the range, you wait. So right here, prices moved down and they rallied. Why did they rally? Because the sellers gave up, they were done. And there happened to be a lot of bullish buying pressure that caused that move up. People wanted to buy, some people were lucky and bought low, But as the sellers disappeared, the bidders had to keep raising their price to attract the elusive sellers. Now, as an institution, you only buy in a range and you work the order. You put in a small amount and keep trying to refresh. As a matter of fact, I don't know if I could do it here or not. Let's see if I go to my active trader. I haven't done it on this platform. I know how to do it on TradeStation easy, but you can do what's called iceberg orders, where instead of buying 100 shares, if I wanted to buy a couple thousand, I could show only 100 at a time, even though my real orders may be 10,000 or 120,000. I could just keep refreshing at 100 at a time, so I blend in. I don't stand out in this level two. I don't scare the market away from where I want to be. You'll even see this in the time and sales. These are the actual number of shares, I think. Yeah, 1 share, 1,200 shares, 700 shares. There's never going to be 10,000 shares coming through every once in a while, but not that often because nobody wants to scare the market. All right, there, 1,000, 1,400, that's about as big as it gets. And that's a pretty heavily traded stock. Okay. So what these orders are, what they do is, again, they break up the order, they buy as much as they can. If it leaves the area, they wait until it comes back and then they'll buy more. So let's say you wanted to buy 100,000 shares right here. You do it in small amounts, 500 here, 500 there, 500 here, 500 there, 1,000, maybe 1,500, maybe back to 500. So you don't scare the market away. And when prices leave that area, those are orders that are left over, unfilled orders. And this is the way all institutions trade. They have since they were on the floor. Now it's all done electronically. It still works the same way. You input in the computer the range you're willing to buy, and the computer works the order for you. I was very fortunate. I had a student fly in from the Kansas City area, I think it was, and he met me up in our New York office for Wealth Builders. And I was working with him because he had large customer accounts. He had, I think, like $60 million assets under management, and he was having trouble getting orders filled. I had to work with him, teach him how to get these orders filled by working the order the way I did as a hedge fund trader. So here you get your 100,000 shares. They may have gotten filled on, I don't know, 30,000 shares. That means there's still 70,000 shares that are needed to be purchased. When are they going to buy? Whenever prices come back to them. Could be a couple minutes, could be a couple days, could be a couple weeks or years. But the main thing is you need to get a good price. You decided as an institution to purchase this security at that price range for whatever reason. Unless the reasons change, you're still going to buy in that area because that's a good price. So right here, if we can identify the origin of that imbalance, we could join here and buy when prices return with the high probability that this leftover order is going to propel prices higher again, this time with us on board, if we jump in with it. Now, what happens after they got more filled? There's less orders filled or less leftover orders. Could it still work again? Yeah, but it's not as probable, is it? You have less there. So the smaller shares contracts, the better chance of getting filled. It depends. Yeah, easier to get filled with a smaller amount, obviously, than there is on a bigger amount. Yes. So, like I said before, what they will do is do an iceberg order. That's what they call it, because icebergs, you only see a small portion above the water, the rest of it's below. Same thing. You're only seeing a certain amount of the order. There may be plenty more. It used to be, I don't know what the refresh rate is now, but this level 2 that you see right here, this level 2, when these quotes were being put out by these market makers, they were obligated up to whatever they show. So for instance, well, Sin's not a market maker, but I'll use them as an example anyway. We'll say it was. So Sin says they're willing to buy up to 1,000 shares. Okay, remember this times 100. So they're willing to buy up to 1,000 shares at that price. They're obligated, and it used to be, I think, 13 seconds. Now I think it might be only 4 seconds. Level 2, that's what this is. Level 2 is showing the depth of the market. They're the limit orders that are being posted by ECNs and market makers and the sell orders on the ask at the different levels. That's all level 2 is. It's showing you the different levels of price that people are willing to buy or sell. Okay. There's no level 3, by the way. That's a myth. It's just level 1, which is the simple quote that you would see, bid ask quote right there. 144.17, 144.18. That's level 1. Level 2 is just seeing all the other people who are willing to buy and sell. Why? There's a 10,000 order. And they just disappeared. They flashed it quick. There it is again. Keeps flashing. So they're obligated for a few seconds once they put that in. Now it says up to, so it's kind of tricky because if they fill one share, they've met their obligation because it's up from 0 to whatever they post. And they can keep that quote there, even though they have no intention of filling any more shares. So there's a bunch of games being played. I don't want to get too much into that, but the main key takeaway is what we need to do as traders is try to identify where's the origin of that imbalance. And the large candles, as you can see here, notice there's a larger range candle, expanded range candle. When it's at a turning point, the beginning of a move, that's often the pros. So we see the expanded range candles here, as I mentioned. We have, that's not what I want to do. So ERC starting to move, those are the pros. But if you see an ERC, expanded range candle, in the trend direction, those are novices chasing. So if it starts the move, it's good. It's the pros. If it's ending the move, it's usually bad. It's novices jumping in and chasing. And here's the thing, prices can go up as long as there's people willing to buy. As soon as we run out of people willing to buy, sellers who are already in start getting nervous and they might start dropping their prices to attract any buyers that are there. That could cause the end of an upward trend. So the same thing in a downward move. So right here, here's a good example. That's a large red candle that's coming after we were moving up. That's the start of a new move. Those are professionals who are selling. And this is also a very large candle, which means there were very few buyers anywhere in that area. In order to get their orders filled during this period of time, that day, the sellers had to drop their prices dramatically. So there's a huge imbalance where there may be a lot of sell orders in that area, but very few buyers. And because this is the start of a move down, those are pros. Well, we want to sell with those pros, don't we? So what happened when we got back up into that area? We didn't even make it all the way up, did we? You can see we got close to it and there's no buyers in this area. So there's no buyers there again. The sellers took over and pushed us down. But notice this candle. This is a candle, and there's a larger range compared to the ones around it, but it's after we've already been moving down, isn't it? So since it's after we're already moving down, it's in the same direction as the trend, those are novices chasing price. And usually they catch it right as it reverses. You don't want to be one of those. If you're making a profit in a position and all of a sudden your profit level jumps, you're making a lot more than you were before, you just had a big move in your favor, you may need to get out because that means everybody got in. I was equated to a flagpole. If I climb to the top of a flagpole, it'll probably hold my weight. But if everybody starts jumping on board and climbing with me, eventually that is going to topple. And the same thing happens in price action. If I go back over to my chart, let's see, get rid of the level 2 for now. Well, here's another example in NVIDIA. Moving down. This happens to be a 1-hour chart. And you can see, started moving down with larger than previous candles. Those are the pros. But then it continued to move down and the novices jumped in. Spike in volume. Let's get rid of this for now. You got a spike in volume. We're already going in that direction. We get the large candle and we're at the end of that move. Now I can go in. Let me take off the after hours here. I put that in because everything's going to 24-hour trading nowadays. So let me just go to say, I don't know, 15-minute time frame. Oops, again, wrong button strokes, keystrokes. There we go. And just go to random time. It doesn't matter when. You know, lots of examples of this. Prices are moving in an upward direction. There's your large range candle, expanded range candle, spike in volume too, right? And what happens? Top of the move. Moving down. Remember, it's the range of the candle, not just the body. That's a large range candle after we're moving down. Okay, we don't have a dominance of red, so we don't have a strong trend. We have a bottom tail that's pretty large, so shape. This is telling us we might be done moving down. Sure enough. Now, going back even further, combining all this together. Okay, remember we talked about color, shape, size, location, right? So for one, this particular area right here that I was just referring to, color, mixed. I should highlight where it is I'm referring to here. Right there. Okay, right. We got mixed colors. So we have a weak trend. There we go. Shape. We obviously have buying pressure because we have that bottom tail on that candle, right? Size. That is an expanded range candle in the trend direction. Novices. And finally, location. It's at a previous demand area. Looking back just slightly here, as we look back here, you can see we had prices that were moving down and buying pressure, rallied up from that area. Lots of green, that's bullish, very strong. That's the origin of the imbalance right there. That's the turning point in price where we're moving down slightly and rallied up. That's where the initial institutional orders came flooding in. These are the leftover orders. So basically, if you combine all that together, the fact that you had mixed colors on the downward move, and we can also probably look at the trend on the higher time frame. Basically, this is from 1224. If we were in a bullish trend, you would expect the trend to continue to the upside. Let me test that theory real quick before I go further. Go to a 60-minute. Applying what we know about color, shape, size, location right here, as prices were giving a little bit of a pullback, what was the dominant color? Green. The trend is up. So which way are we most likely going to be traveling soon? Up. And sure enough, we ended up bouncing shortly there. We ended up going through it later, but initially we had a bounce on the 15-minute time frame. Again, at that area, we were trying to move to the downside. However, color is mixed on this time frame, very weak trend. Shape, we see buying pressure when this one closed. Size, that was an expanded range candle coming into location, a demand zone. Is there any reason was there anything else that I missed that told us we were going to do some sort of a bounce there? Now, we didn't completely go back up. A little bit later we did. But yeah, we actually bounced from this area as it came into that area with that large red candle. Remember, this was a solid red candle at that time. Everything was indicating it was going to bounce there. And we can use those combinations, color, shape, size, location, to get an idea of where prices are likely to go in the future. But keep going here, just looking at color, shape, size, location. Again, we're moving sideways here. Let's clean this one up. There we go. And we gapped down and kept going down. So again, big move in volume there as well. That one's kind of up in the air. I would say that's actually pros gapping price down. We don't have a very strong trend. Obviously, we'll see if this continues to show a strong trend. That's an expanded range candle near the beginning of a new move. So I would say it's the pros that are causing it. But we are pausing just a little bit. As far as shape goes, we've got nothing but selling pressure, lots of selling pressure, and we're still going down. Now, if I'm looking left and down from this area, I need to find those unfilled institutional orders. And basically, as I was mentioning in the E-mini think tank, in the lessons, I have the finding zones, which I'm actually separating the training routine and finding zones in the new version. And the new documents will be out soon, along with the new recordings. I have, where is it here? Leg-based zoning technique. And I basically teach step by step how to find those leftover orders. In this case, if I'm looking left and down, those leftover orders are going to tell me where we're likely to turn. And I can use color, shape, size, and location once we get to that point to see what the highest probability is. Are we going to turn? This was actually another one right here, already used. So it may not work as well. Let's see if it comes back down there again. Came close, didn't actually hit. Okay, here's an interesting spot. I'd have to take a look at the trend on the higher time frame. I'm not going to do that right this moment, but here we do have prices change direction, right? We had a kind of a sideways downward move and rallied up strong. We have a large range candle in the same direction we're already traveling, so those are novices. Okay, now the key thing would really be what's going on in the higher trend, but as of right now, that's suggesting we're going to push back up from this area because I have that large range candle. Okay, somewhat domination of red, not really. I guess it is kind of strong right now. So that's working against it. It's not the best buy opportunity. Let's put it that way. Okay. Again, I don't know the trend overall. Looking at this, I'd say we're sideways now. I don't think this one's going to hold that well. Oops. Let's see what happens. Nope. Didn't hold. Why? Well, for some of the reasons I mentioned. I mean, I spent a lot of time here. It's decent buying pressure out of that area. Location wise, it's not a bad demand zone, but we now have a domination of red. We do have a novice candle, which tells us we're likely to go to the upside, but we don't have a strong trend in our direction right now either. So we got too many things working for and against us. That's why I didn't feel it was very strong. And we ended up moving down. What about the original area? Did we come back down to that at all? Let's see. Nope. Never came back down to it. Anyway, I've kind of run out of time, but obviously, if you liked what you've been hearing here, and hopefully you did, let me go back to where I was here. The color, shape, size, location, reading price, all this is covered in much more depth in the lessons in the E-mini think tank. So I'd love to have you join me there if you're interested. You saw the link before. We'll put that back up there for you. As I said, with that, I do two subscriptions. I do the monthly subscription, but there's also a quarterly subscription that if you click on the link that was in the chat right here under register for E-mini think tank, the quarterly, you get a 2-week free trial, so you can try it out for no risk. You basically get access to everything. And within the next week, I'm going to be reposting all the new documentation, all the new videos, so you get an idea of what it's all about. But hopefully it gave you a little insight into institutional trading and some of the reading price, what can help you. So I want to thank everybody for being here. I got to get going. Enjoy the rest of your weekend and Happy New Year, everyone. If you got any questions, let me know. If not, hopefully I will see you in the E-mini think tank. Again, see if I can post that link up. There we go. If you're interested in joining me. So thank you. Happy New Year, everybody. Oh, hey, Roman, haven't seen you in a while. Happy New Year. Brenda, Andreas, thank you.